Hello, everyone. Thank you for joining our annual Lessons Learned presentation, where we take a look at the closing proxy season and the implications for the coming one. With us today are Melissa Sawyer, who co-heads the firm's corporate governance practice with me, and June Hugh, who focuses on governance and takeover matters. I'll admit that it all blurs together for me at this point. But the backdrop of the pandemic, the heated presidential election, a spotlight on representation and social justice led to a truly dynamic and different 2021 annual meeting season, and I think is going to lead to a similarly different one next year. We saw investors wielding their votes to express views on an array of environmental, social, political, and governance topics, on board quality and effectiveness, and on compensation. In light of the limited time we have, I'm going to barrel right in and introduce the discussion of shareholder proposals. There is a Q&A function at the bottom or top of your screen, depending on how you're viewing this. We will try to monitor that real time if we can, in case there are questions as we present. Sometimes that's not really possible for us, in which case we'll try to get to them at the end or even possibly after the presentation. So looking at slide 3. Shareholders submitted 733 proposals for the first half of 2021. That number in and of itself doesn't mean that much to you, but that is the highest number since we have started tracking, which means that in all likelihood, it is the highest number ever. And it's even more significant when you consider that it's reversing a multi-year trend of declining submissions. So proposals for the first half of 2021 were not only about 15% higher than the first half of 2020, but they were also higher than the full year 2020 and the full year 2019. For the first time, submissions on environmental and social political topics represented the majority of proposals submitted, well, a little more than 55%. Versus 45% last year. And if you again try to put that into context, in 2015, only a single environmental, social, or political proposal passed, and we spent less than 1 page discussing them in our 40-page annual season review. This year, on the other hand, social and political proposals averaged 30% support. Environmental proposals averaged 41% support, and more than 30 of these proposals passed. So looking at the next page, a familiar cast of frequent proponents continues to drive the voting agenda at U.S. public companies. Top 10 proponents account for almost 2/3 of all the proposals submitted. The same set of prolific individual investors that have been most active since we've been talking about this, Chevedden, Steiner, Ritchie, and Young, remain the biggest proponents with over 175 distinct proposals, or almost a quarter of all proposals. As You Sow Foundation was the second most prolific proponent, and As You Sow and Green Century Capital submitted over slightly half of all the environmental proposals. Third was the New York City Comptroller and Pension Fund. This maybe might change, but we don't really expect it. Almost a year ago, the SEC amended Rule 14A8, changing the shareholder support threshold for resubmissions for the first time in over 50 years, and changing the shareholdership requirement for the first time in this century. These amendments weren't effective for this past season, and they're currently under review by the SEC. I think no matter what the outcome is, we don't expect to see much change in the proponent population, in part because of grandfathering. And we're, of course, going to spend a lot of time discussing shareholder proposals. That is the bread and butter of this presentation, but I needed to pause a second on the SEC environment right now for y'all. Depending on how you count, in a little over a year, the SEC has had 5 perquisite-related settlements at this point. The last one was in August. It related to NBC. As part of that, the SEC noted that it's going to, quote, continue to focus on whether companies are fully disclosing compensation paid to their top executives and have appropriate internal controls in place to ensure that shareholders receive the information to which they are entitled. As we continue, as we move into this coming season, as we begin to add additional information into our proxy statements, which we do every year, I think this is an important admonition for all of us, just to be aware of this particular commission's focus on this. Next page, please. Given the large number of environmental, social, and political proposals, we are going to talk about environmental proposals and social political proposals separately for the first time, now truly having 3 categories of proposals, E, S, and G, all separately discussed. That allows you to understand more clearly the differences and the drivers year over year. For example, if you look at this, on this slide, you'll see that environmental proposals increased more significantly than any other category of proposal, even though it represented only about 15% of all submissions. That was driven by a dramatic 75% increase in proposals related to climate. On the other hand, social political proposals increased less dramatically, but became the largest of the 3 categories. Social capital management is a large piece of that, although not the majority. But employee-related diversity, equity, and inclusion was a dramatic increase as well, almost 100%, and is now 30% of this group. But on the next page, when you look at proposals actually voted, governance proposals continue to dominate, as they have since we all have been practicing. They represent the vast majority of voted proposals, and that is because a supermajority of governance proposals, almost 3/4, go to a vote. In contrast, environmental proposals are the least likely to go to a vote and the most likely to be resolved with a proponent. Only 30% of those are going to a vote, but average support increased meaningfully from around 30% to over 40%. The percentage of social political proposals that went to a vote also remained low at around 40%, and average support there was steady at around 30%. So now, with that background, we're going to go into a deeper dive in each of those 3 categories. Before we do that, though, I know Melissa wanted to highlight for you one aspect of how the shareholder proposal process was conducted this year. So Melissa, I'm going to hand it over to you.
What is really more of a procedural aspect of proxy season rather than a substantive aspect of proposals, and that is exempt solicitations. It is a relatively recent phenomenon that has gained a lot of traction with a subset of frequent proponents. As you, I'm sure, know, exempt solicitations were originally designed to address concerns that some issuers had that large institutional investors were supposedly conducting secret solicitations where they were providing soliciting material to a subset of all shareholders. And because they weren't asking to be given a proxy, often the issuer had little visibility into what was in those materials. So Rule 14A6G actually requires holders who own more than $5 million of shares to file that soliciting material, even if they are not themselves seeking a proxy. The phenomenon that we see now, though, is that these filings are not just being made by shareholders who are required to make them. They are being made on a voluntary basis. And there are some frequent proponents who are making regular use of this strategy to use the Edgar system as a way to distribute their soliciting material more broadly in a very inexpensive way to a larger group of shareholders. And in some cases, those materials even appear to have been designed to be used only on Edgar and aren't otherwise really circulating in paper form. We also see these frequent proponents coupling these Edgar filings of exempt solicitations with a coordinated PR effort to draw attention to their proposals and their platforms. So often when these exempt solicitations are filed on Edgar, you might simultaneously see a few media stories pop up, a few blog posts on the same topic. And I think this is particularly an issue for companies that have large, recognizable American brands where the story can really appeal to reporters. It's a way for proponents to amplify their messaging. So I think the key takeaway for issuers from this phenomenon is that if you are opposing a 14A proposal from one of these proponents, like As You Sow, which Marc mentioned, that frequently use these exempt solicitations, I think it's important to warn your internal stakeholders, your comms team, your IR team, that they might expect a little bit more noise around the opposition than you might otherwise see if you just pop something in your proxy statement and oppose it there, and that would be the end of it, because the proponents are creating that noise. And actually, the SEC has shown very little appetite for reviewing these exempt solicitations to assess whether they contain materially misleading statements. So when issuers do disagree with the content of those filings, they really face a quandary about whether they should make a public statement, sort of trying to clean up the record or put their position forward on the issues, which has the downside of creating even more noise around the situation or drawing even more attention to it. The other option, of course, being just to lay low and let the vote play out at the meeting. So anyway, I think this is an area to watch. It's something that I expect we'll continue to see more of in 2022. And it's not going away anytime soon. And the focus of the use of exempt solicitations in connection with social and political proposals is starting to catch on with more and more proponents. So let's talk about social and political proponents. If we go to the next slide. First of all, what is this category? Marc talked about how we've broken out environmental and social political. I think that the social, the S in the ESG continues to be a large mixing pot of a lot of different issues. For example, in this past proxy season, this category would have covered shareholder proposals related to racial justice, diversity, human rights, political contributions and lobbying, and a wide range of other topics as well. These topics don't arise in a vacuum. They don't come out of nowhere. They're very much informed by the social and political movements of the day. So of course, in 2021, as Marc mentioned, some of the big influences were the racial justice protests that swept through the US in the wake of the killing of George Floyd, and the attention paid to political contributions largely followed the insurrection at the US Capitol in January, and was buoyed by the focus on legislative efforts related to voting rights. So these topics that are in the paper every day are also affecting what we're seeing during proxy season. A lot of these social and political proposals are fundamentally requests for the board or the company to prepare reports or enhance their disclosures on the topics underlying the proposal. I think the theory of the proponents is that having asked for the report or the enhanced disclosures, perhaps you cause these topics to start shaping the board's agenda or senior management's agenda, and it gains more prominence within the organization through that avenue. At the same time, because a lot of these proposals can be satisfied through providing enhanced disclosures, we also saw record high withdrawal rates for these proposals. 37% of them were withdrawn in 2021 compared to only 12% in 2020. And I think those withdrawal rates are largely attributable to issuers agreeing to provide those disclosure enhancements, and therefore the proponents agreed to withdraw the proposals. For the proposals that actually did go to a vote, we did see a slight uptick in the support levels for the proposals in many categories, with an especially large jump in shareholder support for proposals related to employee diversity, equity, and inclusion. We also saw higher numbers of those DEI-related proposals, as well as political contribution proposals actually passing this year when they went to a vote. I will also say, just as an aside, we saw issuers having less success with getting proposals, these types of proposals, excluded through the no action letter process. And I think anecdotally, that's because proponents have become more adept at threading the needle and targeting their proposals at relatively narrow demands that are difficult to exclude through substantial implementation arguments, while at the same time positioning those topics as important social policy concerns that are difficult to exclude on ordinary business grounds. So one category, if we go to the next slide, one big category of these proposals, it sort of falls under the umbrella of human rights and racial justice proposals. And those are really two different things. We saw 12 companies receive requests for racial equity audit proposals. And these seem to be especially popular for banks and companies in the financial services industry. And we saw 17 companies receive requests for human rights due diligence procedurals. The levels of shareholder support for these proposals varied a little bit, but I think we'll continue to see more of these in 2022, and so we'll have more data points next year as well. We go to the next slide. As I said, the big category, the big story in 2021 were these employee-related DEI proposals. And 47% of these proposals focused on asking issuers to disclose their EEO-1 reports. Many, many companies secured withdrawals of these proposals just by agreeing to disclose those EEO-1 reports. And I think companies' willingness to do so probably accelerated when State Street put out an announcement saying that they supported this type of proposal. They expected to see this data disclosed publicly. I will say that the way that companies are disclosing the information varies from issuer to issuer, but many are simply putting up the raw data somewhere linked on their websites, and in some cases including some commentary about whether they actually use that data for any sort of internal management purposes For some companies, the EEO1 categories, which were designed in the 1960s and are quite archaic, the categories don't really make sense, for example, for a lot of tech companies. But I think companies have taken the view that if shareholders are demanding that the data be disclosed, they'll make it available to them. In addition to those EEO1 proposals, we did see a lot of other types of DEI-related proposals, which received high levels of support. In some cases, those proposals are asking companies to disclose specific types of retention data for diverse employees, for example, that may be different than what the company is using internally to track its DEI successes and failures. But the proponents have a view about how the issuer should be defining success, essentially. I think we're going to continue to see more of this in 2022. Another topic that really wasn't so much on the agenda in 2021, but I think could be on the horizon in 2022, just from monitoring social media and buzz about it, is the topic of caregiving support for employees. There are quite a few efforts underway right now to draw attention to the needs of particularly female employees to have caregiving support in order to perform their job functions at an optimal level. And this is a topic that could show up in the 1488 space in 2022. The last category of social proposals that I wanted to touch on is the political spending and lobbying proposals. Here, there was a continued downward trend in the absolute number of these proposals, but shareholder support for these proposals continues to tick up. And most of these proposals are requesting that issuers provide more granular disclosure about which political candidates, which trade groups, which lobbying organizations are receiving their political dollars. Anecdotally, I can say that a lot of companies have been reevaluating their political contribution policies, particularly in the wake of the insurrection at the Capitol. Of course, we saw quite a few companies suspend political contributions entirely, at least for some period of time following those events. And I think that a lot of boards of directors are paying very close attention to their policies in this regard, so that we are starting to see some changes on the issuer side about how they approach these issues. And it'll be interesting to see if that impacts the number of proposals in 2022. So with that, let me turn it back to Marc, who is going to talk a little bit about our next category, which is governance.
As I mentioned, when you look at proposals actually voted, governance proposals continue to dominate. Structural governance proposals, written consent, special meeting, proxy access, those kind of proposals represent about 75% or 3/4 of all governance proposals, and even a higher percentage of those voted. Board composition proposals, board diversity decreased in prevalence a bit, so about 1/4, and was even less of those actual voted. The support increased this year to 40% in total. That was driven by those proposals that average more than majority support, adopt special meeting, majority voting, supermajority voting provisions, and declassify the board. As was, and we can go to the next slide. As was the case last year, proponents submitted more proposals for written consent rights. They did for any other governance topic. Almost 1/4 of all the governance submissions, up from 1/5 last year. Most went to a vote, and very few passed. Unlike special meeting rights, many major institutional shareholders and many issuers have a concern that acting by written consent in lieu of a meeting can actually frustrate a orderly process as opposed to support shareholder empowerment. But there is a significant percentage that think written consent is a significant and steady percentage is an important shareholder right. Most of these written consent proposals are adopt proposals. When we look at the structural governance proposals, we've divided them into those proposals that ask you to adopt something for the first time, and those proposals that didn't like the way you adopted it and would like you to amend it. So with respect to written consent, as you can see from the slide, it hasn't been adopted by a majority of the larger companies. And so most of those proposals are adopt proposals, although we saw a threefold increase in amend proposals this year. Most of the amend proposals sought to lower the ownership threshold to 10% from a more typical level of 20 to 25%, and that threshold is the threshold necessary to set a record date for the written consent, which is very similar to what you see is technology to the special meeting provisions are sort of related to each other. All of those proposals received ISS support last year. The year before, where we had 5 of those proposals, the proposal was to set the ownership threshold at 3% to set a record date, and none of those received ISS support. Of the 10% ones that we had this year, average support was just around 40%. So we're going to see more of these. When we go to special meeting, we did have relatively high levels of proposals to either amend or adopt special meetings. Given that more than 4/5 of S&P 500s have a special meeting provision at this point, there you see a switch, and you see most of them focused on amending, and again lowering the ownership threshold to call a special meeting. The average support remained relatively high, although it was a little down from 2020 at over 30%, suggesting that a meaningful percentage of shareholders are not satisfied with the 20% or so ownership threshold that is prevalent in about 3/4 of S&P companies that have special meeting rights. Only one proposal to amend special meeting rights, however, passed this past year. We haven't really talked about proxy access in a while. This past season saw a reversal in the 3-year decline in proxy access submissions. This past year, there were 31, only 2 of which were adopt, and the rest were amend. Treviño was the filer of most of these. Average support was strong at around 30%, but none of them passed, even though ISS supported each one of them. If we go to the next slide, our second category of governance proposals, moving from the structural ones, which really were the foundation of this type of discussion over the past decade and a half. The second category is board composition, and those fell significantly year over year. Submissions on independent board chair fell by almost 35% and almost by 50% on board diversity. Part of that is almost undoubtedly the high level of attention that this topic has received from other stakeholders. I'm sure you're all familiar with the new NASDAQ rule and with the California legislation. And this is obviously a topic that all of the major shareholders are aligned around at this point. Only 2 board diversity proposals, for example, went to a vote, only 3. The 2 that did received very high support. They requested disclosure of underrepresented groups on the board in terms of gender, race, sexual orientation, ethnicity. They passed by over 80%. I think one was even over 90%. The only one that failed, to the extent you want to call it that, was a true diversity proposal, which demanded that the board diversity efforts include political beliefs. And that proposal received very low support, which is consistent with true diversity proposals the year before. And so we just need, when you think about this category, you need to take out these sort of anti-diversity proposals that you see in there. We've heard about, and proponents have submitted a handful of director qualification and employee director proposals this year, just like they did last year. But support for those categories, those proposals remains low. Director qualification proposals focus on disclosure of director skills and qualifications, usually like industry specific. 3 went to a vote, and they were at tech companies and requested disclosure of human or civil rights experience. And I think they average around 10% or below. And then there was a second category, as I mentioned, of proposals that requested the inclusion of non-management employees as director candidates, which generated a lot of discussion as a very European concept. 7 went to a vote. At Amazon, it received more than 15% of the vote cast. It had ISS support, but it's the only proposal like that. But I think just given the types of conversations all of our stakeholders are having, and given that particular outlier, I expect you'll see a bit more of that. We can't really talk about governance without talking a bit about the process of conducting annual meetings themselves, which has dramatically shifted in the pandemic. And again, I think I'm going to turn to Melissa. Did you want to talk about that real quick?
Well, I'll just say, I mean, we continued to see widespread use of virtual meetings in the 2021 proxy season. I would say it's still TBD if that will continue in 2022. A number of issuers are still wrestling with that question and don't have to decide that quite yet. On the plus side, I think many issuers have found the technology to host virtual meetings works quite well. However, a few organizations representing institutional shareholders, as well as some of the frequent proponents, have complained vociferously about how some of those virtual meetings have been conducted, specifically around the opportunity for the proponent to engage in live Q&A or to present their own proposal live. So I think there's still some debate about whether entirely virtual meetings will continue in 2022. And I expect we may see some differences across sectors, with some tech companies, for example, continuing forward with virtual meetings, while some other companies may prefer to go back to in-person meetings or hybrid meetings. So I think it's still up in the air at this point.
The next category we wanted to cover is the environmental category, which, as Marc said at the top of the hour, we for the first time have separated from the social and political proposals so that we can see the trends there. Before we get into the topics of the proposals in environmental, I wanted to briefly touch on the engagement between companies and proponents on environmental proposals this year. The trend here was pretty interesting and shows the type of change Melissa talked about earlier, where what's happening in current events is really impacting the way that companies and proponents and other stakeholders, such as institutional investors, were part of the story on environmental proposals this year. This year, more than any other year we've been tracking, it appeared that companies were willing to engage with the proponent rather than allowing the proponent's demands to go to a vote. And as a result, environmental proposals, which had been withdrawn at a pretty high rate in recent years, finally passed the withdrawal threshold of over 50% this year, with around 60% of those proposals being withdrawn. A word of caution, however, is that rarely did these environmental proposals, did the proponent agree to withdraw a proposal unless the company agreed to full acceptance of the proponent's demand. And then when the proposals did go to a vote, which happened in 28% of the proposals submitted this year, shareholder support increased from 32% in 2020 to 41% this year. So quite a meaningful increase in support. This year, a record number of proposals, 12 total in number, or a third of voted proposals and 10% of all proposals in this categories that were submitted, received over 50% support, with 11 of those proposals being that passed being proposals related to climate. The high level of support on environmental proposals, particularly those that related to climate change and climate related goals, was very much driven by institutional shareholder support this year. From other contexts, we've seen evidence of these investors' focus on environmental issues. For example, when CalPERS and other institutional investors supported the new activist in engine number 1 in successfully unseating 3 Exxon directors in a proxy contest. And then in the shareholder proposal context, institutional investors such as Vanguard have come out and indicated that they'll support environmental proposals on climate change if climate change is a material risk for the company and the request is reasonable, addresses a gap in disclosure if the proposal relates to disclosure, and aligns with industry standards. So moving from that to the types of proposals that were submitted this year. As Marc already previewed, the vast majority of these proposals were related to climate, and they included demands for companies to commit to meeting specific emissions or other environmental goals, as well as reporting on their climate-related metrics, including improvement in goals year over years and meeting specific targets that they've set for themselves. One category that was not high in number, but maybe an area to watch, is the category of proposals that are now being called Say on Climate proposals. There were 6 of these proposals which asked for the adoption of annual shareholder votes on climate transition plans. the shareholder support on these proposals varied. There were 3 that went to a vote. So the data here is not maybe enough to support any particular trend, but the support ranged from 7% at Monster Beverage to 32 and 37% at Union Pacific and Booking. Despite the low number of Say on Climate proposals, however, the fact that institutional shareholders are supporting other climate-related proposals may indicate that companies will be more willing to consider adopting annual advisory shareholder votes on climate-related issues, perhaps even in the absence of a shareholder demand. And some evidence to support that hypothesis is the fact that some companies have already gone ahead and adopted a Say on Climate vote. And those that did, including Moody's and S&P Global, received overwhelming support for the climate transition plans they put up this year. And when I say overwhelming support, I mean the support levels were 99% or higher. So one other area of environmental proposal that we didn't see this year was we didn't really see this year, was proposals relating to standardized environmental or ESG reporting. This is an area we were watching closely because, as you know, of the intense focus in this area from other stakeholders such as the SEC, federal and state legislators, as well as other industry organizations. There was only one shareholder proposal that was formally submitted at a US company requesting that they adopt standardized disclosure. And in this case, it wasn't even to adopt the full standardized disclosure regime just relating to water issues based on Sustainability Accounting Standard Board's framework. This proposal went to a vote, and when it went to a vote, it only received 11% shareholder support. The low number of the disclosure proposals here, as I already said, is likely linked to the high level of attention from other stakeholders. And it will be interesting to see where these proposals go, if any further ones are submitted, depending on the outcome of ongoing discussions at the regulators, legislators, and other stakeholders. So moving on to compensation proposals, this will cover very quickly because compensation proposals remained a very, very small portion of the overall submissions this year. And in fact, this category, which is the smallest category every year, further decreased by 20% from 2020. This year also, the support for these proposals remained low at 23%, and no proposal received a majority of the votes cast. As was the case in prior years, the majority of these proposals were proposals to link compensation with environmental or social impact metrics. Although these proposals to link ESG issues with compensation also saw decreases in both the overall numbers and average shareholder support.
We're nearing the end of our presentation. We're going to talk about Say on Pay and equity compensation briefly, but if you have questions that you would like us to address, please use the Q&A function now. Otherwise, if we don't have questions, heads up to my fellow presenters, because I'm going to ask them for a prediction for 2022, and so they can either listen to me or think about that during the next 5 minutes. and I'm happy to go first or last, depending on what my presenters decide. Before we talk about say on pay for a second, it's worth noting that we're not talking about no action relief. Every year we talk about changes in this process and developments, and we know that for the 2020 season was the first time that the SEC stopped giving all written responses and began using verbal responses, and we did have a change in the commission over the season, but it really did not generate any change so far in the no action process. Spoiler alert, it would surprise me if we didn't begin to see that in this coming season. But what we saw this past season was over 95% of the responses by the staff were verbal. The success and failure rates were generally the same. It took a touch longer to get a response from the SEC this season than it did the season before, which is likely a function of the pandemic and simply the changeover administration. The average response time increased to 2 months or 60 days. There is this controversial category of failure to state, of declining to state a view, which the staff did not do at all over this past year, and it's only done once since it adopted this 2 years ago, which was where the proposal was the subject of litigation. So as we look at say on pay and on equity compensation plan approval, in some ways there isn't that much news here, not nearly as much as I thought, but when you look underneath the numbers a bit, you see more. So at the top level, you continue to have support levels averaging 93%. You continue to have less than 3% company failings. You continue to have ISS basing its decisions on its historic model and pay, and with the most influential feature being pay for performance. But as soon as you go a bit below that, you will see that it was a more challenging year in a way that foreshadows for more challenge in the coming year. So if we look just at the next slide, there are just a lot more numbers that are a little helpful to see. If you look for the Russell 3000, you see the numbers are literally almost unchanged. But when you look at the S&P 500, a slightly different story emerges, particularly with respect to that last row, which is to say that during this period, ISS negative recommendations carried meaningfully more weight than they have historically. So while the 4 recommendations by ISS were consistent, 16 S&P 500 companies actually failed this year, which is up from 11 last year and up from 7 in each of 2019 and 2018. If you look past the models and look to see what some of those companies have in common, one is special long-term incentive awards. That is something that we've seen a meaningful amount, both during the pandemic and right before it. And a meaningful number of those companies, the majority, the super majority of those companies, all had special awards I think the other thing you saw is adjusting incentive payouts. These are things that we talked about last year as anticipated because of the pandemic. I think that the takeaway is that ISS and Glass Lewis were generally tolerant of adjusting annual payouts, but were much more critical with respect to long-term payouts. I think the difference in average support also is meaningful, and maybe to a certain extent you would look at it and think that the 5% doesn't matter. But if you look at the percentage of S&P 500 companies that had 90+% as an example, from 2018 to 2021, we went from 4/5 having 90+ down to less than 3/4, and that has shifted to the 80 to 90 percentile. So you're just starting on a lower base at this point, which just doesn't come through in these numbers. And then if you have an extra 5% change as a result of additional leverage by ISS voting, you can easily move from above 70 to below 70. It's almost and then well closer to 50%. So I think that this foreshadows an actually more difficult say on pay season for this coming year. So I could go on, but I feel that we probably have some questions. So a couple of the questions are on the change in shareholder proposal rules and where we are. Those rules are scheduled to go into effect, but they're under review, and they're certainly not very popular with either this commission or this administration. We don't know where they'll stand. They do have within them some grandfathering provisions for persons who held the requisite amount of shares under the old rules over time. And so even if they go into effect, just my expectation is we're just not going to see any meaningful change in the population of proponents at this point.
Marc, should we do our predictions?
Oh yeah, let's do the predictions. I was trying to understand one of these questions, but I got stuck. Yes, let's do the predictions before you lose time.
Yeah, if we didn't get to your question, we'll respond separately. But June, why don't you go first? If you have one.
Yeah, I think this year we're seeing a little bit of a holding pattern of the proponents based on where where things are going to go on the legislative and rulemaking agendas. So I think one of my predictions is, depending on what is happening with this administration, with all of the changes, the legal changes that are being discussed and considered, I predict that there may be a return to some of these issues, like environmental disclosure. Marc talked about board level diversity. Some of these issues may become once again the issue, the point of focus for shareholder proponents if they feel like there is no satisfactory resolution. That's just my 2 cents.
I actually agree with you, June, and I think that climate and emissions disclosures are going to continue to be a hot topic and will grow in importance in 2022. So I think people should really be thinking about how they're going to react when shareholders impose additional demands for disclosure and use of specific frameworks and so forth. Marc?
I think that we are going to hear more about racial equity audits. I think those proposals went to some major companies, and they got either some support or reaction. And I think you're going to see more of that. Period. I think you're going to see more say on climate. I know there's some division over it. I know it's been a sleeper for a couple of years, but I think it's coming, and I think it's got the same type of division around it as say on pay originally did. And I think that we're going to see it, and I think we're going to see some more rulemaking, not affecting the season, but after the season, around some of these long-lived rules that I'm sure this administration would very much like to push through, like clawbacks, and pay for performance disclosure. So that's my prediction for the season. Thank you for joining us, and good luck in the upcoming season.